So is Google stock at a max pain or max opportunity? What's going on, guys? It's Ricky with TechBot Solutions. A quick little heads up. I am a little under the weather, but I really wanted to make this video because I wanted to dive a little bit deeper into Google, what was announced, why it sold off, and why I'm choosing to buy. Let me make this very clear though. Just because I'm choosing to invest, in no way is that a reason for you to invest. You buying the dip on Google, especially with just a few shares, you're not going to become a millionaire overnight. That's not the point of it. The point of it is I want to highlight how good of a deal Google is based off of what the company produces in revenue to what it's currently valued at. That's the entire purpose of this video. I already started investing into Google very lightly, and I would love to invest more as things begin to show signs of progress. With that being said, let me go ahead and just jump right into it. I hope that I earned your thumbs up. Please consider subscribing. And if you ever want to watch me trade live, click that second link in the description down below. So let's go ahead and break it down. So what happened this week? I'm sure some of you guys might have seen Google took an absolute nosedive. I think it sold off about 9% from overall highs of 163 to lows of 147. So 9.72% ended up closing right around 152, 7.5% in the red. And then a lot of consolidation around here. If we look at the larger time frames, one thing I love to share with our beginners is different time frames give you different perspectives. It's always really important, even as a trader or as an investor, to look at different time frames to give you different timelines, right? The thing that I want to highlight is, well, why did Google end up selling off? So this is the thing that, again, we can quickly break down is that why did Google's parent company Alphabet stock tumble on Wednesday? And it's very simple. So Apple reported that the iPhone maker is looking to add an AI-powered search option to its Safari browser and suggested that they could possibly or eventually replace the standard search engine like Google. For those that do not know, when it comes down to search engine revenue, that is, about 57% of the way that Google produces its revenue. So there's no sugarcoating that. If Apple were to do this and create their own and not have Google as their possible default, first off, I actually didn't know that Apple had their default as Google. I thought it was always Safari because I've always had to download my own version of Google, but it's, I think, because I use Chrome. Maybe that's a different one, but nonetheless, search engine revenue, 57%. And I'm much more of a visual learner, so I hope that this does a better job kind of breaking it down for you. You can see that the way that it produces revenue, 57% of that is based off of its search engine. So there is no question that if Apple does end up moving forward with this, it will have an impact in future earnings for Google. So let's make that very clear. The risk is there. I'm not trying to sugarcoat that. The thing that I want to highlight is everything else about Google. One of the biggest factors that has been growing year after year is its cloud-based revenue. Its cloud growth is up 28%, and it is one of the fastest growing sectors within Google. Now, Google is a very large company. So I wanted to explain first the why. Why did Google end up selling off? It exceeded most recent earnings, both earnings per share and revenue. But because of that negative news of Apple possibly looking for an alternative, obviously not having Google as their default would have a direct impact on Google. Now that we have that figured out, or that we understand that, this is the thing that I quickly want to highlight. And again, feel free to let me know your thoughts down in the comment section. The PE ratio. For those that do not know what this means, the PE ratio, which again, just depends on how hyped up your stock is or not. The PE ratio gives you a better understanding of what the company's price is right now versus what the company is valued at and what the company makes, right? So price versus earnings. So this is at a multiple of 16.8. And if we look at history, and again, this is just taken into, in comparison, Google is an incredibly valuable company. It's one of the most valuable companies that's publicly traded. It sits at a $1.85 trillion market cap, and its PE ratio is only 1.85. I mean, that's pretty impressive, meaning that it's not trading at that much of a multiple of what it actually earns, which is, very attractive for a lot of long-term and fundamental investors. That's the best way that I could put it. If you invest or trade a company that has a very high PE ratio, let me give you an example of this. The example of this would be something like PLTR. So PLTR is a very hyped up stock right now. It's kind of like Wall Street's shiny new toy. The company doesn't make as much revenue as what it's valued at. So you're just paying a premium is the best way to look at it. Is if you're okay with that, then you're okay with that. But then there's obviously the risk if it doesn't meet up to its expectations, because you're obviously investing into a very hyped up stock and its future projections, that if it doesn't meet future expectations, then the stock can crash because it trades at an insane multiple, 485 times its earnings, right? But we can also compare it to other companies. If we compare it to other companies that are more along the lines of where Google's at. So if we try to compare it to some of the Magnificent Seven, NVIDIA being a very strong company, trades at a multiple of 39 times its earnings. This is twice as much as what Google does, right? So there's twice as much of a premium on NVIDIA based off of its projection for growth, right? If we look at something like Tesla, I'm sure many of you guys won't be surprised, but trades at a current 157 times its earnings. We can pull up Apple again being one of the most valuable companies that's publicly traded, trades at 30 times, so nearly double. And then let's pull up Microsoft. So as you can see, again, the thing that I'm just trying to highlight is that a lot of these very valuable companies do trade at a multiple, but it's not an insane multiple. It's not like PLTR. And it's not normally like Tesla. We all know that Tesla's kind of like an outlier when it comes down to that. Another one that's pretty crazy is MSTR. You guys know that I love talking shit on MSTR because a company doesn't actually produce any revenue. This thing trades at a negative multiple. So negative 21.3 times its earnings because the company doesn't actually make money. The company is valued based off of its Bitcoin holdings. Again, a very different thing. So a lot of hype factored into this, but it's very interesting to pay attention to the PE ratio. Now that I highlighted the importance of the PE ratio, the whole reason that I'm sharing this with you guys is because it emphasizes if you're paying a premium or if you're paying close to fair market value for it. And if we look at this, its current PE ratio versus what it's been in the past before, I mean, it is literally at a PE ratio of 17 to 16, right? 16.8. It has not had a PE ratio that low since, it doesn't even let me go past 2010. So this is the thing that I want to emphasize is based off of what the company produces in revenue as of right now, which can ultimately change based off of the news of Apple possibly replacing Google. I want to highlight that. I'm not here to sugarcoat that or ignore that, right? We have to take that into consideration. But based off of what it currently produces and what it's priced at, it is trading at one of the lowest PE ratios in the past 15 years. Isn't that pretty interesting? I thought that was interesting. That's the whole reason I'm making this video. I thought that was a fact worth pointing out. And the thing that I wanted to share with you is I found this post to be pretty interesting. Google stock, point of maximum pain or maximum opportunity. You guys can decide, right? To every investor, we're all wired in different ways. We all see value in different ways. And like I said, by investing in Google, even if it does end up recovering back to previous all-time highs, which again is a possibility, right? It's one of the Magnificent Seven, one of the most valuable companies that's publicly traded. It offers 35%. So even if you invest $100,000, which again, I'm sure not a lot of people would, right? As you're just, if you're just a lot of beginners watch my videos, you'd make $35,000. It's still a great amount of money. But the thing that I want to highlight with that is I'm not here to convince you to invest in Google because you're going to become a millionaire tomorrow. That's not the point of it. The point is to be able to identify an opportunity that is with a good company, that is valued fair, that possibly is experiencing pain right now, so fear, to be able to invest during the downturns, and if you can tolerate it, to make money during the upswing if, again, things do get better for it. It's not like we're investing in a pump and dump or anything like that. I just wanted to highlight that, the opportunity aspect of it. When taking that into consideration, after a 20% year-to-date decline, Google trades at 41% below its 10-year PE ratio average. So again, that's kind of like what I just showed you. It's definitely trading at one of the lowest in the past 15 years, but based off of its 10-year average, 41% below versus what the company makes versus what it's currently valued at. My analysis shows a 60% probability of positive regulatory outcomes. I don't really care about this. I don't care what anyone's probability is. That's not important to me. A lot of price targets. Again, these price targets are from 205 to 230, neutral 170 to 190, and negative is 130 to 145. The thing that I like about this is on investing.com, it tends to highlight fair market value. It says fair market value based off of a series of different analysts, 50 different analysts. It says a fair market value is 190, 161. Again, and I only take this still as a reference, never as a sole reason on why to invest in something. But based off that analyst, those series of analysts, it says uncertainty, low, upside 25%. And I think that's important to talk about. Like I said, this is not your crypto. This is not your PLTR. This is not your HIMS. This is not your AMC or GME. This is not your pump and dump. This is for people that, even if you just buy one share, this is the whole point that I want to highlight. Even if you just buy one share and then you see the return, you're putting yourself in a position first, if it's something that meets your criteria, that has to be the most important part. You see the potential, you see the opportunity, and it meets your criteria. The second thing is with the one share, we call it the one share test buy with our LPP team that's designed for beginners. You do it just as a proof of concept. It's not because I'm saying it. It's not because anyone else is saying it, but you do it to have some skin in the game. So you do it in a tasteful way. So if Google does end up selling off a little bit longer, you're not stressed out about it because, again, you just own one share of the stock. Even if it goes all the way down to 100, you're like, oh, dang, I'm down $50. Who cares, right? The whole point is when you're just getting started, you don't want to put yourself in stressful positions that you cannot tolerate. I don't care if you have $1,000, $1 million. The whole point of getting started is to start as a beginner. And I think the best way in doing so is either paper trading or starting with a very small dollar amount. So the best way that I think in being able to do so is with that one share test buy. You buy wherever it is that you see to be fit. If Google meets your criteria, great. And then if it ends up recovering and you see the 25 to 35% return, now it's not because I said it. It's not because you heard it from someone else or someone else's experiences. You experienced it yourself. Obviously, you're not going to become a millionaire. Obviously, you only made $50 on that investment. But the whole purpose of that is now you understand the importance of buying when markets are greedy, identifying opportunity and fair market value, and taking advantage of it in a tasteful way that, again, not only thinking about the upside, but because of your position size management, you can tolerate the downside. Based off of when the news came out of Apple, I actually told my daughters and my lady's financial advisor to buy some for them. And I actually ended up buying some myself in my long-term account. And that's the thing that I love to do is that I love to invest during downturns, but in a tasteful way. I'm not trying to make it or break it. And tasteful is different for everyone, right? It just depends on your risk tolerance, on how much experience you might have in this market, and what you're comfortable investing with, right? Some people are starting with maybe a few $100s, a few $1,000. Some are investing with $100,000 to a few million, right? It's not about what I'm investing or you're investing with. The whole point is to get started, to get some skin in the game where you see to be fit so you can learn from your experience. So even worst case, if you do invest in Google and you only do it with that one share and this thing starts to tank to $100, and you end up wanting to cut losses, then at least you're able to experience it yourself. You didn't lose an insane amount of money. You still lost possibly $50, but at least you did it in a tasteful way. And that's the biggest encouragement that I ever want to have with the people that follow me. As the beginners, especially those that follow me that are part of LPP, I always just want to make sure that you're never afraid to take advantage of opportunities. You just do it in a tasteful way. So I thought Google and the PE ratio focus was something that I really wanted to highlight and emphasize. You guys let me know down in the comments section what you think. Would it be something that you would consider investing in, knowing that its PE ratio is incredibly low? Knowing based off of its history, it's at one of the lowest P ratios that it's been at for the past 10 years, but also taking into consideration that its search engine revenue is 57%, and based off of Apple's most recent update is that it could possibly replace Google. So based off of its default search engine, something to take into consideration. Let me know down below. I appreciate your guys' time. I hope that earned your thumbs up. Please consider subscribing. And again, if you ever want to join my LPP team, which is designed for complete beginners, I think that if you you enjoyed this video, you'd really enjoy being a part of our team. You get access to my daily live training session, and you get access to the A to Z video lesson library that's designed for complete beginners. You can learn everything online yourself, but again, if you prefer to learn with a little bit more structure, that's the whole point of LPP. Second link in the description down below. We have a little discount code there for you. Like always, let's make sure that we end the year on a green note. Take care, team.